Hello and welcome to Beyond the Deal, the podcast where we go deeper than the numbers and we talk about the tips and tricks that lead to success in life and business. Today on the show, my guest is Carson Jones. Now, I've met Carson through a mastermind that we're both part of for capital raisers, and he's got a really interesting story as a serial entrepreneur who's been in oil and gas, real estate, started a marketing company, been in the restaurant business. So we get into all of that. And most recently, he wrote a book called The Red Flags Playbook, which is a sort of guide for passive investors on what you need to know in order to get into deals. So without further ado, let's get into the episode. Carson Jones, welcome to the podcast. Glad to have you here.
Thank you, Michael. Thank you for having me on.
Yeah, so for our listeners who don't know anything about you at all, why don't you give a quick introduction? What do you have going on right now at this moment?
At this moment, I've published a book called The Red Flag Playbook. It's available on Amazon. I'm an entrepreneur. Been doing real estate for over a decade now, oil and gas. Did a little short stint in corporate America. It wasn't for me. Like a lot of people, didn't like the control, the cage and all that. Jumped out of there, been involved in several different companies from restaurants to a marketing company and just trying to be free and build and grow with other like-minded folks.
All right, wonderful. We're going to talk about the book in just a minute. Fantastic book. I highly recommend any of our listeners to go check that out. And we'll kind of talk about, the thought process in creating that book. But before we get there, why don't you tell us, you started out in corporate America and then you had an aha moment, you left. What was that moment? Where did you end up?
That's kind of a weird thing for me. A lot of people talk about rich dad, poor dad in our industry, and I kind of have a little different take on it. A lot of people come from corporate America and they had a big salary. Exited corporate America at a very young age. There wasn't a $300,000 salary. So just like rich dad, poor dad, I was very poor in the very beginning. It's starting a marketing company, knocking on a lot of doors back in 2007, almost 20 years from now. Not a lot of money there, building up. But in a good way, that changes you. It kind of puts your mind on a swivel to where you're always seeing competition and how things work. And it's kind of helped me later on in real estate and in business as far as when do you back up, when do you play offense and defense, on real estate, that I feel like I have a little bit of an edge with, but you're always learning, that's for sure. So anyway.
So after leaving, the first thing you did was start a marketing company. That was your first entrepreneurial venture?
Yeah, and it's kind of a crazy story. I started a marketing company without a website. My friend and I we were walking into companies, and this gives you an idea of how poor we were. We were going in with a CD disc. And this is back in probably 2007 with a presentation on it. And we didn't even have a website. And our thing was we weren't leaving without a check. So it just goes to show. And then every check we got, it was like we won the Super Bowl. We celebrated that night. It was like, yeah, but it was a lot of fun, but it's just different not having a check. Before that, my checks weren't that big, but it was steady pay. But getting out there, and it's like, I remember coming out of one company and I left the disc up and Ryan's in the car and he's like, "Where's the check?" I said, "Well, he said he'd have it tomorrow. We'll go back by." And he's like, "I'm overdrawn $200." And he's just like, so he calls, I left the disc up there by accident and he calls up there. And he finds a way to get the check because he's so destitute and broke, just to give you an idea of how broke we were back then. But we worked up and built the business up to where we were finally able to afford a website, built it from there, got it to where you're making over $100,000 a year, just growing. Then I started restaurants, saved a little money. It's a baby step process of being an entrepreneur, a lot of stumbles along the way, but I've grown a lot from doing it.
I think that's a really common thread in entrepreneurs is that most of them are serial entrepreneurs and the rate of a failure is high and the rate of success is low. But the common trait is that none of them give up and they always pivot, right? Just because you throw a bunch of stuff at the wall and it doesn't stick doesn't mean it's not going to stick the next time. And you have to keep throwing. So you get out of marketing and now you're in restaurants. What was that transition like?
Well, restaurants really opened my eyes. It's one of those where it was dealing with people, you're the boss, motivating people to show up was my main thing. I wanted people to work hard when they were there. You have an employee you don't know what's going on in their personal life, so to say. I mean, they have a lot of baggage everybody has baggage to a certain extent, but when you're dealing with that level of employee, you really have to motivate them to show up and work as hard as they can. I always tried to motivate them, incentivize things. I didn't want to be down their backs every 2 seconds. I wanted them to have fun. And, people who had a poor home life, where things might be toxic at home, they enjoyed working better than they did being at home. So I learned a lot about people and, just marketing the business. But it's another moment where it really kind of affected me as far as seeing competition, because when you're in the restaurant business, and I was in it for a long time, I'm not in it anymore, but there's always a new restaurant popping up. So you have to be aware, and they're always doing an opening campaign. Prices are coming in with a different product, and you have to constantly be changing your menu. And it just creates an environment where it's constant adapting to competition and changing and evolving. One of my restaurants I sold in 2013, to give you an idea of how long ago it was, and it's still open today. So it wasn't necessarily a profit thing. A lot of people go in there and they fail. And I did make a mistake on that restaurant, is I signed a bad lease. Everybody makes mistakes in business, and that's one of Sam Walton's first mistakes, is he signed a bad lease. It was successful. The lease there's always a chance to renegotiate it too if the business is bringing in money. So, that later changed. It was sold and it's still open to this day. But some of those, as an entrepreneur, I think I heard Kevin O'Leary say, there's a difference between entrepreneurs and entrepreneurs. They see that the business starts to own them and they get away from it so they can do other things. And I saw that the restaurant business kind of owned me. And it was more of I was freer than corporate America, but I was still owned in it to an extent. So a lot of that's actually in my book. I talk about that. It's a red flag. My book's not just about red flags for real estate. It's in life. On the internet, you're going online and they're constantly, hey, you can just go start a laundromat, or you can do this and it's going to be easy. And, it's never easy. It's just not.
Yeah. So I remember when I was still in college, and my father is an entrepreneur as well. And I went to him and I said, hey, Dad, I think I want to own a restaurant one day. And he said, Michael, literally get into any other business, because the margins are terribly thin.
Well,
Employees quit all the time. They're all having sex with each other. They all steal from you. Get into any other business.
Well, I knew, like, if I had a friend, he told me, if you don't give them free food, they're going to steal.
Yeah.
He said, basically, you're incentivizing them not to steal. You're saying, here's free food so you don't. Right. But there's still one or two that end up taking from you. And it's just part of it. And it pisses you off, but it's just like, dude, it's part of the business. You signed up for it,
So I love that you brought up the book, and, we're going to spend a little time on it in a second. But as it relates to kind of our typical audience, these are people who are familiar with the world of real estate syndication and raising capital. And so you get out of the restaurant business. How do you end up in the oil and gas world and raising capital?
I started investing passively. I don't even know what year it was. It's been over 10 years. I don't know. Probably 2013 era, somewhere in there, 2012. Just started doing it, dabbling in it on the side. I had a partner that was his sister was doing oil and gas, and we were just doing small amounts of money back then. And then, she kind of passed away, and I was like, I kind of want an oil deal. And I'd been investing in real estate and different stuff. So then I kind of got the idea to get my own deal. It's just, entrepreneurs just keep having ideas. Some of them are good, some of them are bad. Oil, the riskiness of the asset is real. I've done probably 10 oil deals, maybe more. Had some nightmares in there that were not so pleasant. Had some that are good, still paying today. So, I don't want to say the industry's bad, but I'm not going to sit here and act like it's riskless either. So there's a way to play it. But right now, my favorite asset class is real estate. And I can proudly say every investor I put in a real estate deal has always at least got their money back. So, it's one of those where real estate's my go-to. That's where I'm looking to explore right now and, grow. So anyway, I'm also, I forgot to mention in my opener that I'm a broker, commercial real estate broker. So if any of you have a lot of syndicators that listen, if you're looking for a property or looking to sell a property, no matter what state you're in, I could probably help you. So find a buyer for it. and all that. So anyway, that's
Thank
a little self promo. I said I wasn't going to come on here and sell anything but the book, but
Hey, I mean, this is your moment to shine. This is why we bring people here, right? Well,
yeah,
speaking of self promo, let's talk about your book. I think
yeah.
that, this is a really valuable tool for potential LPs when they're kind of vetting different asset classes or different operators to kind of understand what are some of the things that they should be looking for. What was your thought process? How did you even decide to write a book and kind of, who is this trying to serve?
It's one of those where I wanted to have a guidebook. This book, I wanted to have more of my investment principles, which I kind of have in this book. I like to bet on founders that have you're betting on the people, and everybody knows that, but also understand the economics for it. What are you looking for a deal? So I wanted to have a guidebook, that laid out red flags, and along the way, talk a little bit about corporate America in the very beginning, the first two chapters, run into what a syndication is. What are the questions to ask? I think in our industry, another problem we have is we use terms like IRR. When I'm talking to a software engineer or a dentist, they're like, what's IRR? They don't even know what a cap rate is and all the terminology. What's the waterfall? You got a lot of smart people that want to invest in real estate, but they don't want to feel stupid by asking questions that are really basic and simple questions, but they don't understand the terminology. So the back part of the book is really loaded with a lot of information as far as the index and basic dummies guide to what is real estate, what are all these terms. And then the inside of the book goes through what's a syndication, what are you looking for, what are you looking for in a sponsor? Do you do a background check? It's one of those where most background checks, you just see a DWI. Really what you're looking for is it shows you how to get on the SEC website, if they've had a SEC violation, stuff like that you wouldn't really think about. You have a lot of people out there saying, should I look for bankruptcy? Well, in real estate, they don't file bankruptcy. So it's kind of like you can, but there's other ways to vet the deal, vet the sponsor, vet what they're saying, vet the assumptions. What are the red flags in these assumptions? How do you check it and ask the right questions? How do you check the rent comps? And then in the book, what are the red flags for like cold storage, being close to railroad? It starts jumping through the asset classes, and there's just numerous of them for each asset class that it goes through. So it's pretty thorough. There's a piece in there for everybody. I'll say that. So not everybody's going to look at cold storage. Not everybody's going to look at data centers, but they just kind of skip over that part and just keep going. It talks about taxes and other stuff towards the back and all that. So it's pretty thorough on all of it. So anyway.
Well, I mean, as it pertains to my audience, I would say, why don't you maybe give us a couple red flags to look for in a multifamily?
On that, it depends on the owner. You show up to a multifamily producing financials that are only in Excel. They don't have proper accounting records, walking the units. And a lot of these are questions you ask the sponsor as a passive investor. It's like, if you're a passive investor, like a doctor sitting at home, that's not necessarily your red flag, but you want to ask the sponsor, hey, did you walk the units? Vacant units. What could be a red flag is a ton of cars in the parking lot at 10 a.m. Just various other ones that I've listed in the book, but it gets pretty detailed as far as what to look for, all that. Rent comps, how do you check those? Is it realistic? Is the sponsor telling you this and you pull it up and it's not checking out? Verify the rent comps, So it's just the tips how to vet a deal real quick, So
Yeah, something you mentioned earlier that I actually tell my passive investors all the time is you really do bet on the jockey, not the horse at the end of the day, because
yeah,
a good operator can take a medium deal and turn it into a success, and a bad operator can take a great deal and ruin it, right? And at the end of the day, the passive investor really only kind of has control over two or three things. I mean, first is the asset class. So once you've decided, okay, I know I'm going to invest in a multifamily, then the second thing they have control over is the market. And once they know that I want to invest specifically in this market, the third thing is the operator, and that's it. Those are the only three things they have control over. And so you better be sure about all three of those things before you go in.
yeah.
And, as somebody who personally has gotten into partnerships that I've had to buy my way out of because, not everybody is who they appear to be at the first glance, right? And when you get into a syndication like this, you're actually getting into like a 5-year marriage, right? There better really, do your due diligence on the person that you're giving your money to or the person that you're choosing to invest alongside of. I think that's the biggest deal breaker.
Yeah. And a lot of what you're getting at is why I wrote the book. Because, if you've been in business more than 10 years, you've made a mistake on a partner before. You've had a deal that's kind of acted up and people didn't do the right things. So that's part of growing and learning is vetting people and making sure you're getting in bed with the right person because you really are getting married. One thing I was going to say is on walking the units, it's, walking in there and there's very few belongings and stuff like that. Like somebody doesn't really live there, on the multifamily.
There's a million things that can come up during due diligence. And sometimes you think everything is going right. And then the next thing you know, a guy drives his car through a wall. These kinds of things happen, right? And as operators, it's really on us to, be as transparent as possible with our investors and share the good, bad, and the ugly at all times.
I got a funny apartment story. This is back in college. I was standing out on my patio talking to my neighbor, and this guy flies over the hill with his truck, runs over the apartment sign, and then he turns into the apartments and he gets out of the car. And the cops arrest him at this doorstep. So we lived in our apartment complex and we're watching this going like, oh my gosh.
Everything's normal here. Nothing to see. Yeah. These are the kind of things that happen, especially when you get into like, C-class apartments. It's not for the faint of heart. I will tell you that myself. It really is not for the faint of heart. But it comes with higher cash flow typically. It also comes with more volatility. If you invested in an A-class apartment, you're probably not going to see the same sort of cash flow, but you're going to have, a different kind of tenant quality. It's just the things that LPs need to know. Hey, really quick, I hope you're enjoying this episode. I just wanted to stop for a second and thank our sponsor, which is me. Nimble Capital Group is my boutique investment firm, where we help passive investors access deals built for cash flow, equity growth, and powerful tax benefits. And if you think you've ever wanted to learn how to raise capital and become a GP yourself, I coach a select group of students each month, most of whom will raise over $500,000 within their first 60 days. So check the show notes in the description below to book a call. I'll see you there.
I think one thing right now with multifamily is, it's been some tougher years, but I think where you're looking and with yours in Arizona, you got to really look at the investments being made in the U.S. and the growth. Where's the $5 trillion going? Arizona's got to benefit from that. I mean, I haven't studied that market very much. Every market's different. Some of them, it's like, if you're like 30-minute difference here in Nashville, you can have 11% vacancy. You travel 30, 45 minutes and it's down to 2 or 3%, So it can vary widely in each market, but I could see some really good tailwinds from the investments coming into the U.S. for you guys there.
Well, so this is probably a really perfect segue to say, I know what's going on in Arizona. I know there's a ton of money being pumped into development here. And, Trump has, love him or hate him, he said that he's actually a mainstream president, right? So he's trying to bring manufacturing back to the U.S. And certainly we haven't seen the impact of that money yet in terms of jobs and income, but it's coming at some point, right? So where do you see the real estate markets going in the next year or so?
Man, I think you're in a great spot. I like Arizona. I think it's going to be very selective. Pick your spots, looking for operators that are picking good spots like you, whether it be I think industrial, multifamily, and very select markets. I like the Nashville area. I like, I think Arizona, I don't even know that much about it. I know it got overbuilt and had some trouble there, but, I think it's got a lot. I think that's a boom town waiting to happen. The growth's not going to stop. That's what I think. So there's got to be, nationwide construction's basically come to a halt. That's another thing people have to understand about multifamily. There was, back when interest rates were so low, a lot of supply was being injected into the market. That's basically came to a halt. So it's a great time to buy. I think interest rates come down. I don't know. I always talk, if you read my LinkedIn, they need to come down, and I'm kind of dissing Powell a little bit, but you can't do anything about that. If your deal fits, it fits, so.
Yeah, you buy in
Anyway.
whatever part of the cycle you're in, as long as the deal makes sense now. I do know
Yeah.
Powell has to step down in May of next year. Who replacement will be, we have yet to see, but that will certainly be an interesting time.
Yeah.
Now, at the end of every episode, I like to talk a little bit less about the business side of things and more about sort of the struggles of entrepreneurship. So you've mentioned basically getting out of corporate America, starting one company, pivoting to a different niche, getting into real estate, being a broker, also raising money. How do you balance all this stress? How do you stay sane, especially with the volatility of the last couple of years, with what real estate markets have been doing?
With real estate, I got really stressed, man. In 2021, I'll just be really honest. I got real stressed. And I did oil and gas, and I thought that would be like change everything. But all my real estate friends are like, who's this idiot showing up with an oil deal? And I'm like, and they didn't really see the economics shifting like I did. And it goes back to that entrepreneurial thing. But back then I was drinking a lot, if we're being honest about it. And it's one of those things where I don't drink now. I think that's really helped me a lot. Getting up in the morning, being more clear-headed. You don't realize it. Say you're grumpy in the morning, but you're even more grumpy after you've been drinking the night before. And it doesn't fix anything. Things are going to work themselves out. Real estate's going to have its ups and downs. So it's just, how do you manage stress? It's one of those things. It's just maturing a little bit and knowing how to deal with it. Can drinking be a weekend activity? Yes, but it doesn't need to be a nightly thing. Back then, during those stressful times, it was a nightly thing, and it's not anymore, which I'm really proud of. It's made me more clear-headed, and, so.
Getting sober, a big part of the path to success.
Yeah.
I think a lot of entrepreneurs are prone to extremes. It's kind of in our DNA a little bit. A lot of us are searching for the next big thing, searching for the thing that will fix it all, searching for that. And, I've seen plenty of people fall into, drugs and alcohol as a vice, a way to combat all that stress. And
well, it can be a good thing. I talked about in the early years, it was so much fun when we'd go get our first check, and we were dirt poor. And everyone was like, we won the Super Bowl, and it was fun, but it can go the other way where you're drinking because you're depressed and not happy.
And your body responds a little bit differently when you're in your 20s than your 30s.
Well,
you back a little bit easier the next morning.
Yeah, you're not lying.
Nothing happened at all. It doesn't feel like that anymore, I'll tell you what.
Yeah, that's truth right there, man.
All right, well, perfect. Carson, we are out of time, but thank you so much for being here.
Yeah, I appreciate you. If you need any help or anybody that listens to your show, they can reach out to me at carson@passive.investments. And, look forward to staying in touch. They can contact me on LinkedIn, and thank you for everything. We'll be in touch. Okay.
Thank you. That's a wrap for today's episode of Beyond the Deal. I hope you got some valuable insights that you can apply to your own investing journey. Now, if you've enjoyed this conversation, do me a favor, hit that follow button, leave a review, and share this episode with somebody who you think could benefit from it. It really helps the show grow and bring on even more incredible guests. If you want to go deeper, make sure to follow me on your socials. You can find the links in the show notes in the description below. Thanks for tuning in, and I'll catch you next time. Until then, keep going beyond the deal.